So we've established now that in order to comply with GAAP, generally accepted accounting principles, that we are required to use the allowance method. And of course, that's if it's material. And so in order to, but the IRS, on the other hand, uses the direct write-off method. So we're going to look at both methods here and show what the expense will be. So in number one, it says, what is the bad debt expense for 2021 as a percent of credit sales? And we've got the Irwin Company uses the allowance method for uncollectible accounts receivable. Bad debt expense is established as a percentage of credit sales. In 2021, net credit sales totaled $4,500,000, times 0.015, because our percentage of bad debt is 1.5%. And when we do that, we come up with $67,500. So that's part one. What is the bad debt expense for 2021 as a percentage of net credit sales? Assuming that, now we're also told in there that our beginning balance was $42,000 and our ending balance was $40,000. So if we were to look at a T account, allowance for uncollectible accounts, our beginning balance is $42,000, sorry. 42,000. Our ending balance is 40,000 when it's all said and done. And we know we wrote off 67,500 for bad debt expense, and the offsetting credit is allowance for uncollectible accounts. And so the only way to get there is we had to write off 69,500 in accounts receivable. So that's how much we wrote off during 2021. And then part three says, if the company uses the direct write-off method, what would be the bad debt expense in 2021? What would be the amount that we wrote off, the 69.5? So using the allowance method, we used bad debt expense of 67,500, and using the direct write-off method, we write off 69,500. Now, it is GAAP to use the allowance method. However, under IRS accounting, income tax accounting, we have to use the direct write-off method. And the reason why is because what each system is trying to prevent. On financial accounting, which is what we're focusing on in this class, what the rules are trying to prevent is management from overstating things and making things look better than they actually are. Well, what you're trying to prevent, the IRS is trying to prevent, is taking too large of an estimate, right? Because that is an estimate, that 67,500 is too large of an estimate, but it's an expense. And so if we have a large expense, it would lower our net income. Lower net income means lower taxes paid. So they don't want us to underpay our taxes. And so they make us do the direct write-off method so that we don't have an allowance. And of course, there are some companies that don't have to do that. If you fall under regulatory accounting, such as a bank or a financial institution where another arm of the government tells you how much you're going to write off, then you use the allowance method even for the IRS. But generally speaking, most people use the direct write-off method for the IRS. So that's the difference between the allowance method and the direct write-off method as we go along.